Right, it's CPI Eve. All right, this is the day that we've been looking forward to for a while, heading into the February meeting, the FOMC meeting. The president has a press conference scheduled for after the CPI. You would assume that he knows something if he's going to schedule that press conference there. So the CPI is expected to be much better than expected. I think it's expected to be about 6.6% headline year over year. Of course, considering this press conference and the whisper numbers are that it's going to be even better than that. That the month-over-month figure will be negative. The market has really rallied in anticipation of that. So I'm going to break down kind of the bullish returns that we've seen so far and what we can expect to see going forward, and the kind of move that we kind of need to see to turn the ship around and really get that Tom Lee rally and get going to the upside that everybody's a lot of people have been talking about over the last little bit. Of course, we've also seen periods like this play out before where we get a good number that we've been trying to price in and the market just sells it off, sells off the event, and we end up going down to new lows. So we've seen that happen. So I'm gonna show you some of those instances, see how they compare to what we've seen over the past week. So let's go ahead and get started. Today is Wednesday, January the 11th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our classes that we have coming up. If you come down to the bottom, click this heart. It opens up this tab. Hit that like button. Same thing, click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you like and share and comment on these videos, on these social media platforms, the more it gets out to all of our followers and beyond. I really appreciate all the likes I'm getting on Twitter, for example, to the point where we're getting tens of thousands of views on the tweets because of that. So thank you very much, and keep that up, and you can do that right now while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we finished with the bear tag here yesterday on the S&P, and then now today finishing even higher, up 1.5% up above the 30-day moving average. You can see the near-term line again has continued higher without the momentum line. We've seen this before. We've seen multiple instances. In fact, at the September CPI meeting, we had a really strong bullish run over 4 days, very similar to these 4 days. We had a really strong 4-day run going into that. The near-term line took off without the momentum line, and then we failed on a CPI report that was actually pretty decent because it started to fall. This was for the August report. This was the second month in a row of it falling. And so we're seeing a very similar pattern develop here where we're running up. See, every meeting after that, we went down going into the CPI report there. We went down. We had a 3-day run, but then the day before, lost all the gains, pretty much went down going into that report in November. And then in December, you can see we were down going into that report in December, and we were down coming out of it. And then now we are back to going up going into the report again, very similar to what we saw in September. And again, like I said, without the momentum line. And here we didn't get above the moving average. Here we are above the moving average. And in fact, the moving average has turned green, so it's actually turning higher. The intermediate line's rising. It's not above 50 yet to get the dark green shading to go with it, but it is rising. It's also still below its market sentiment line. So as bullish as it is, it's not as bullish as it needs to be. The NASDAQ got its own bear tag today, so this is the first instance of its own bear tag. Again, the near-term line taking off without the momentum line, again, very similar to what we saw in September going into that CPI report. The Russell 2000, and you can see that NASDAQ did get above that 23% retracement. The Russell 2000 is back at its 50% retracement level. Its near-term line is at extreme highs. We are 2.5. We got the green. The moving average has turned higher. The intermediate line's turned up. It's out of bearish territory. It's really bullish. Again, going into this report. And then finally, The Dow Jones Industrial Average got the first bear tag. It was the earliest of getting it. But then it hasn't been as bullish in the last couple of days, not nearly as bullish as the Russell. It was only 1.25%. Intermediate line rising out of bearish territory, but definitely not in bullish territory yet. So you can see the setup going into tomorrow's report. The setup is a bullish report with, again, without the momentum line leading the near-term line up to where it wants to go. And again, we've seen this before, right, where we had just started to be bearish. It looked like we might turn it around. We actually got above the moving average this time. We did not there. But it looks like we might have, we got a cluster. We came off of that cluster. It looked like we were going to turn it around without being bearish for too long and come up off a higher low point, and we formed a lower low. This is obviously a much higher low point, at least on the Dow. On the NASDAQ, it's not as, it's not as high, but we did get a cluster at the beginning of this, and it looks like we might be ending this bearish run. But again, like I said, we've seen this play out. The weekly crossover chart, you can see here we got a green arrow last week. We got the transition last week, and as of right now, we have the reversal candle this week because we're closing above the body, last week's body. So we actually are looking really, really good on the S&P 500. The NASDAQ is not looking as strong, but it's still okay. Right? We're still closing above that. The Russell 2000 we mentioned is the strongest. And it finally got the green arrow this week on the reversal as well. So there's some good potential for the markets here with that. Looking at the 3 green arrow chart, of course, we have 3 green arrows across the board. 2 days in the Russell, 3 out of 4 on the Dow, and then now 2 days on, or at least 1 day on the S&P with the green arrow. We actually got the green arrow yesterday. I don't know why it's showing it for today, but we had 2 days there, and then now 1 day on the NASDAQ. 1 to 2 days, if it gets into more than 1 to 2 days, then now we're bullish, right? If it stays at 1 to 2 days and we go right back to at least 1 red arrow tomorrow, then it's done. Then that's a peak, right? That's a 3 green arrow sell signal instead of an actual buy signal there. Let's take a look at the moving at the 2 line versions of these charts, and you can see again we've closed above the 30, we closed above the 50. We're filling in the gap to the 200. You can see just how important this 200 moving average is. We failed at it multiple times. We're there again. We haven't crossed above multiple moving averages. We kind of crossed above the 30 and the 50, but only because they're sitting on top of each other, and we're at the point of control. So we're at the point of control. We're below the 200-day moving average. We're below multiple Fibonacci resistance levels, 38 on the market sentiment decline, 62 on the intermediate decline. There's a lot of resistance here in this level. It's going to take quite the move. Otherwise, the expectation is that resistance will hold. Especially the stronger the resistance it is, the more likely it is to hold. You got multiple lines here. So keep that in mind about about how these charts are looking. The S&P did close also above the 30 and the 50, again way below the 200, and then again also below the 38% Fibonacci, and the 62 and 38 is way up here. That's where the S&P is. IWM is now at the 200-day moving average. So here we are with the opportunity to break above the 23% retracement. There's a 32 up here, and the 62 on the green is right there, these old highs. So it's got a little bit more resistance up above, but you're at the 200-day moving average. So you can kind of see we've run up to levels that we can fail at, some significant resistance levels here, especially the 200-day moving average that we can fail. Looking at the DMI, we are above 30 on the positive. We are a titch below 20 on the negative. That's actually a good sign right there. IWM looks pretty similar. The Qs, remember, has been a little bit less bullish, but it has a very similar pattern as well. I mean, that's a pretty darn good pattern to be above 30 and below 20, even if they're just barely past each of those levels. The RSI and the CCI, we are in strong bullish levels there, well above 150, well above 50. We're making its way towards 60. Like, we got some strong moves going on the RSI and the CCI charts. You have, the Ichimoku cloud. We are at the top of the cloud. We are above the blue line. We're still not through the cloud. We don't have a bullish trend going there. IWM is in the cloud, and the Qs is still at the bottom end of the cloud. So it kind of gives you an idea. But at least the bearish trend is done. The rate of change is still negative for the Qs. SPY, the rate of change is also still negative. So we're still missing, a really good break up to the upside to really solidify this move. The hull looks really good. I mean, that's a good pattern. The McClellan oscillator, so breadth looks really good as we got up to almost above 100 on there. Now that was kind of, the peak of the McClellan oscillator back here, but still that's a really good move with the summation index turning easily positive. So really good opportunities. And one thing that's really standing out that again has stood out as a negative pretty much all year long continues to be the money flow. So when we got down to the 50% Fibonacci retracement, or the 50% here on the green line, that's where the money flow was. And then as we rally back up to it, as you follow my cursor along, as you rally back up to it, we did not get back up to that high. We actually got through the 50%, got all the way up to 62, still did not get up to this level where my cursor is. And you can see over where we are now, we're nowhere near even close. And the price is actually higher than where my cursor is. The price is higher. This was 390, we're at 395. The price is higher when we hit the 50% retracement. But the volume, money flow, which is the volume normalized by the price, is still very, very negative. Like it's way worse. The money flow index is positive, and it's actually above 60. But we're still, it's the same issue we've had all year long. And again, for an example, going back to say the last correction we had in 2018, to kind of give you an idea of what it looks like when you do, here let's do the Fibonacci retracement. When you do hit that 50% Fibonacci level on the way back up, so here's where we hit it on the way down. You can see we hit it there. At that level, we hit it right there, and we hit it again right over here. So these levels where my cursor is where we hit it on the way down, and then on the way back up, we were right up here. So you notice here's the 50% on the way back up at these prices, and you follow my cursor to the left, they're above those lows. So that's what it looks like when a correction bounces back up when the volume supports it. And this is what it looks like when the volume does not support it. And that's an issue. That was an issue back here. That was a huge red flag in August, and why we weren't bullish on that, even after the CPI report, when it continued higher for another 4 days. And it continues to be the biggest red flag for us now on the S&P. So that's a problem. That's a problem there. The other problem continues to be the VIX. The VIX is really, really light, really, really low. It's at 21. It's relatively high, but considering this big event risk tomorrow, it's actually pretty darn low. In fact, financial conditions right now they came out today, and I tweeted about this. Financial conditions are looser now than they were back on May 20th of last year. The overnight rate was at 1%. It's at 4.5% now. The Fed's balance sheet has been drawn down by 5% since that May 20th peak. The VIX was at 29 back on May 20th. The VVIX was above 100, and now the VVIX is below 100. It's below 80 still, even with the rally. It's below 80. The VIX is at 21. The market is not worried about the Fed over tightening. The bond market is saying the Fed shouldn't even raise rates at all, as you'll see here in a minute. And the stock market is saying, you know what, we're not really worried about the Fed. We think the Fed will do what the markets are telling it to do, like this has been the case for the last so many years. And we have a really, really complacent VIX that is set up for a move to the upside. Again, that September meeting or August meeting right there, and then that September meeting right over here where the VIX was coming down going into the CPI report. We were set up for a move to the upside, and we're set up for a move to the upside again on volatility coming out of the CPI report. You see the intraday move. We did get a higher high, higher low. They were both above yesterday's high. They were both above last week's high. This has been a good bullish run over the last 4 days. again, we've seen a good bullish run over a 4-day period before our CPI report that the markets were estimating was in the market, the stocks to the moon, at least back up to old highs. And then it failed miserably back then in September, and that's the concern now, especially again with the, I showed you the VIX. So that September meeting right here, the VIX ended up going from being at under 23 all the way up to 34, above 33 all the way up to 34. So, it failed and it took off, and we're even lower now than we were then. In multiple instances, the VVIX is lower now. The ATR is lower now. I told you before that the ATR, for the VIX to have its ATR below 10 for so long is so incredibly rare, unless we are in the teens on the VIX, and we're not. So again, it goes to show just how much the VIX is compressed and is ready for that type of big move. And in this case, to the upside, as well as I've also mentioned too, the seasonality of the VIX suggests a move to the upside. So here's the seasonal move. That's over the last 5 years. This is the seasonal move of the VIX over the last 20 years. So here's where we're at right now. So we're headed for, in that particular time frame of a typically bullish time of year. And I also mentioned to you before too, the correlation of the VIX to the S&P over the last 4 weeks has been rarely positive. It's been turning back down finally, but it's been pretty rare for it to be as positive as it has been, and typically it also leads to a jump in the VIX, all these other instances that it's been above zero. All right, now let's take a look at what's driving the price action today. Of course, everybody's watching for the inflation report, but that doesn't mean we didn't get some big moves. This is today's one-day move. And look at real estate up 3.5% today. Real estate is pricing in lower interest rates. The interest rate, the 10-year yield, look how much the TLT rose, up 1.5%, almost as much as the Qs, as well as commodities. That's not a risk-off, a risk-on pairing there to see long-term bonds with commodities in the Qs. And you can see the dollar was flat and gold was flat as a result. And with the dollar weaker, international stocks underperformed U.S. equities. Let's go back to the last 4 trading sessions. So we'll go through Friday. Remember, these are the four days that so far the market's been pricing in what we're about to get. 4.25% up on the S&P, 1.75% down on the dollar. The yields are down. The gold is up because of the weaker dollar. Commodities are up 3.5%. The Qs are up 6% in the last 4 days. 6%. Again, to kind of give you an idea of just how much that is. Let's go to the rate of change here and change it to 4 days. 4-day rate of change. And let's go to the NASDAQ. 6%, 6.15. You can see this has been one of the stronger 4-day rallies that we've seen in the past little bit. 6.15, 672. Really good move. Of course, we saw a bigger move coming off of the inflation report in November, right? But this was after the inflation report, not before. In September, we saw the exact same move. 6.06% was the rally we had in September going into the report. Almost the exact same move that we have going into the report. You can see what we were coming out of the report in August. You can see some other moves. In June, we were up coming off of, these are all coming off of, significant, rather significant low points here. You can see the 4-day rally there, 4-day rally. We're coming off of a low point, relatively speaking. We've been flat for the last few days, so we haven't been that low. And of course, you can see the 4-day rally, which exceeded 10.5%, coming off of that low back there. So, and here was a 4-day rally of over 8%, 6% there, including that down day, and before we ultimately turned down. So this is not to say here's a 4-day rally of 6%. This is not the first time that we've been 6%, but you can see this is pretty high. Like for us to get another 1, 2, 3%, we'd end up with this kind of these kind of moves to the upside of nearly 10% in 4 days. that'd be a rather significant jump. If I were to change this to 5 days, because tomorrow will be a 5-day move, right? If I were going to change this to 5 days, you can see this is where we're at right now. You know, we can get up to a couple more percent in 5 days. Remember, we're up 6%, so it's actually going to be, we're already here at 6% over the 4 days. So we're already at a pretty decent 5-day return. You know, to get up more than a couple percent, which is kind of what the market's looking at, like that looks like it tends to be a peak for the market move. So for the NASDAQ over a small percentage of time, and then you can see the fake out move that we had at the end of March, beginning of April, that turned out to be really bearish, because that started a big long run to the downside. So you can see, like, we're not necessarily, like, we're probably a little bit too bullish going into the report. Remember, the Russell's been the most bullish, up 4% in the last 5 days. But if I were just to go to 4 days here, the last little 4-day rally, it's been pretty strongly bullish. It's got the more bullish market forecast, and you can see 5% 4-day returns. And you can, like I said, if I were to go back to 5 days, we're already at 5.18, depending upon what we get tomorrow. So here's the 5-day return. So we're about right here where my cursor is. We're already at a pretty decent 5-day return in just 4. So it's going to really limit the upside, because if we do get a strong return tomorrow, that would create some really high 5-day returns that have been hard to sustain in the past. There. So keep that in mind when we're looking at what kind of returns we might expect coming out of tomorrow's, what's expected to be a really good, better than expected CPI report that the markets are hoping, especially the bond markets are hoping, will put the brakes on the Fed. You can see the Fed rate hike odds of 77%. The 3-month is actually still pricing in the rate hike, right? We're at 4.71%. We're going to get up to 4.75 by the end of February, but the 2 years not. So the spread between the 3-month and the 2 years now at 50 basis points. That in the past has been a bottom for that yield spread. And again, the only way that this goes up is if the market's wrong in one direction or the other. Either the Fed does not raise rates in February and 3-month drops, or the Fed implies that they're going to raise rates a lot more than just February. You can see we have an 85% chance of getting the 5% by March. That the 2-year has to start to ramp up the price that in and catch back up, which again will have an impact. I mean, look at the 10-year 3-month spread is at 118 basis points. That is unbelievably and extremely low for this spread. It is insane how low the yield spread is getting. We're at 118 there today. That's an extreme, as you can see, it's an extreme low, and when it's been this low, it's really preceded some significant recessions. Again, the reason why it goes up is because the Fed cuts rates. The Fed's not expected to cut rates anytime soon. So we're either going to go into deep inverted yield territory, which means the recession we'll have will be even worse than what we've seen in these last two, where the yield spreads have been smaller, bigger, well below zero, excuse me. We're bigger now, we're more below zero now than we were then. So the recession now will equal what we saw the last two recessions in bear markets, if not be worse than that, if we continue to move lower on the yield spread. Because again, the Fed is not cutting rates anytime soon. They have stated that they recognize the policy error of the 70s, where they stopped cutting rates. See, if the CPI continues to fall at the same pace, we get down to 6% at the next reading. There in March, and then the Fed raises rates to 5% in March. Right? If we follow suit on that, the real Fed funds rate will be at -1%. That's where this blue line is. This line will have gone up to -1% by March, by the March CPI reading, and then subsequent FOMC meeting. Right? That's the Fed stopped raising rates in the 70s at around that area. And we saw what happened with the second run in inflation going forward from there. And again, the Fed said they're not going to do that. And so don't, I mean, again, the Fed has kind of mentioned that they want to get the real Fed funds rate positive. Even in '06, they got the real Fed funds rate to 250 basis points. The real Fed funds rate. Right, if the CPI drop, if they stop raising rates at 5, that means the CPI has got to get down to 2.5%, and we would finally be at 2.5%. And that's, I think, we want to stay higher for longer. That's the higher they want to get to, and then stay there for longer. This isn't the higher for longer. -1% is not the higher for longer. Positive 2.5%, which is where they were in the 90s, going into the 2000 recession, before the 2006 when they stopped raising rates in '06, and of course the whole 80s. That's the higher for longer that they're looking to get back to, this precedent of positive real Fed funds rate, and get out of this conditioning of the markets being conditioned to expect negative real Fed funds. And so keep that in mind. I think the market has not priced that in from a market perspective, either the bond market or the stock market. And once they do, then that's the pain, I believe, that Powell has frequently mentioned that the economy could very well feel in the process of getting this back to normal policy rates. Let's take a look at how the sectors performed here today. So bear with me while I bring up the sector comparison chart. And again, just looking at today alone, and then we'll look at the last 4 days. So here's today. We saw real estate doing very well, right? So of course up 3.5%. Discretionary benefited from Tesla. Today up 2.5%. You can see technology up there too. Communication services lagging. Staples and energy lagging. Okay, now let's go to the last 4 days. So starting on the 5th, Friday. You have communication service or consumer discretionary, technology, materials, and real estate all up 6.5% to 7%. I mean, that's a really good 4-day return. The market itself up 4.25%. We looked at that already. And then you can see healthcare, staples, energy are the lagging. Look at utilities doing pretty well. Again, benefiting from the drop in yields that we continue to get. All right, the TNX dropping down and almost back below 3.5%. It's going to be really hard for this to really drop sharply below 3.5%. You can see other risk asset classes also benefiting over the last so many days. The Bitcoin getting back up to a really important support level had broken below at this 78% retracement level. You can also see a point of control there. So Bitcoin is also at a resistance level that it can fail at. Another reflection of risk appetite is the ARK investments. Again, it's at its 50-day moving average. Strong MACD, strong stochastic. So again, another strong 4-day return at the very bottom of this tremendous volume node that again it can fail at. So all these different risk asset classes, all that resistance, all across different levels of risk, that we can either bust through tomorrow after already achieving a really good return to get to tomorrow. To build on that is, the problem is this 4-day return is really limiting the kind of return we can get out of tomorrow in a matter of like a 5-day, for tomorrow, or a 6-day return by the end of Friday. Again, you look at that rate of change, the rate of change here, and you look at the 4-day rate of change, especially for something like the NASDAQ 100. Go to the NASDAQ here. Again, you can see how high we are, but now let's change it to the 6-day rate of change. So that would include through Friday, through the end of the week. Again, we're already at 6.1 whatever percent. So right in this area, right here, that's where we're at already. Without any return. If we were flat, perfectly flat tomorrow and Friday, we would have a pretty good 6-day return, relatively speaking, to what we've had. And all these other returns that have been so high, we've peaked, right? We've peaked at these levels with these returns that are that big, maybe going up another couple of days. So it's not necessarily, again, the best thing to have gone into the CPI report with such a strong return. All right, let's take a look at today's report. And you can see green across the board. Green in all the big names. Microsoft 3%, Apple 2%, Amazon 5.81%, Tesla up 3.68%, Home Depot up 2.5%, and Lowe's 3.5%. Airbnb kind of fitting in that same category up quite a bit. Google up 3.38%, Baidu 2.87%. So green across the board. Chinese stocks not doing as well. Some of the chip stocks not doing as well either. They're up, just not quite matching the same returns that we were seeing in some of these other big bellwethers there. You can see some of the safe havens not doing as well, right? Some red over here in Deere and Caterpillar in the industrial name, Clorox and Procter & Gamble, what had been working pretty well, CVX, some of these energy names not doing as well either. Schwab financial name down, Verizon, a big telecommunication services, of course, down. So let's take a look at Procter & Gamble. That was where we did our trade idea of the day in our Market Outlook live video at 3:30 Eastern time before the market closed. You can see it was down. It's been converging for quite a while. I got a bull tag, which means we closed below the moving average, got the yellow line, and we closed. We crossed the moving average, and we got the pink shading. And you can see, like I said, the intermediate line, the near-term line forming a pretty bearish peak here, just barely getting above 60. When you look at some of the other charts, like the two-line versions of this chart, you can see we closed below the 8, 17, and the 30 all at the same time. There's a pretty decent gap here. Again, look how long we've been converging with the MACD below its moving average, but staying above the 17-day. But you can see the tide has kind of changed for the stock. As we had this big strong trend. Now we're almost at a negative rate of change over the last 26 days. Looking at the DMI for the stock, they have been so bullish. Now not so much. Both lines are in between 20 and 25. The RSI and the CCI not nearly as bullish anymore and dropping down to bearish levels. So what we decided to do on this trade was to say, okay, let's do a bear call spread at that mid-30s delta. So sell the 155, buy the 160, and go out to a full position size. So there's our trade. Again, earnings is coming up. So we have to keep that in mind. But the return suggests that the markets are not expecting earnings to be a big deal before January expiration. As you can see, that break even is right there. So if we were to break out after tomorrow or with earnings, if we were to break out, then we'll get out there. We'll try to limit our losses if we can to $350 because that's what we're trying to make. But that's the kind of move it would take up to there to get to that point. So, and of course, if we do make that move to there, we're going to want to be out of the stock and move on to something else at that point. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between the videos. Again, remember to subscribe to our website at marketscholars.com. Like us on Twitter and Facebook as well. Hit that thumbs up down below. Subscribe to our YouTube channel and comment. Have a great rest of your Wednesday night, everybody. We'll keep our fingers crossed for a good day tomorrow coming out of the CPI. We'll talk about that in upcoming market outlooks before this holiday weekend, before we have a Monday off for next week. So have a great one, everybody, and we'll see you all next time.